Good morning, everyone, and thank you very much for joining. This is Monday, it's the 30th of May. My name is Russell Schumer, Senior Market Specialist at FXCM, and welcome to the morning market review. My email address, arshur@fxcm.com. Just going to bring up our high-risk investment warning. I'll keep this on screen for a few moments. And here's the market commentaries disclaimer. While I've got that on, I'm just going to bring up the non-farm payroll link. I forgot to do that. I'll just pop that in the chat. Give me one moment. Okay, so the link for Friday's non-farm payroll is in the chat. The other options, just to send me an email and I'll send you the link as well. Here's our references, MarketScope 2.0, CNBC.com and TradingView.com. Hey Katie, good morning. Nice to have you on the webinar. Thanks very much for joining. Hope everyone had a good weekend. And I'll just move this up for the moment. Let's just go through the morning note from CNBC, which reads as follows: European stocks set to nudge higher, tracking global sentiment as dollar weakens. European stocks are set for a modestly higher open on Monday as the US dollar weakens, with traders easing expectations of aggressive monetary tightening from the Federal Reserve. Shares in the Asia Pacific rose sharply across the board on Monday, with Japan's Nikkei 225 adding 2.3% to lead gains ahead of a big week of economic data. And sentiment was boosted by a relaxation of COVID controls of the weekend in the major Chinese cities of Beijing and Shanghai. Markets in the US are closed for Memorial Day, and that's after the S&P 500 and the Dow Jones Industrial Average snapped losing streaks to post their strongest week since November 2020. And that's probably going to have a liquidity effect on a broad basis, but certainly the stock market, there won't be any trade except on the futures market, but it's going to be very thin. The US dollar index, which tracks the greenback against the basket of its peers, was hovering below 101.5 on Monday morning. Okay, so they're talking about the DXY there. Let's just bring that up. All right, so here's the DXY. Okay, the US dollar index, which tracks the greenback against a basket of its peers, was hovering below 101.5 on Monday morning. The index earlier notched a 5-week low as fears of further aggressive interest rates hikes from the Fed, beyond those expected in June and July, eased over the past week. Earnings in Europe on Monday are set to come from Forex Capital, while data releases will include Spanish and German preliminary inflation prints for May, along with Euro area economic sentiment and consumer confidence surveys. All right, so I think this DXY chart is actually a really appropriate place to start for the week. Katie asking if we can take a look at Nasdaq and oil, and we certainly will be able to do that. All right, so let's keep the DXY on for a moment. I'm going to go through to MarketScope. So this is the daily chart for the certainly has pushed into zone 3, and you can see you've got this squeeze happening over here. So some volatility coming in. Going through to our weekly chart. Okay, so just to show you, I've jumped from dollar back to weekly. The dollar was extremely overbought after this run here. This was with the jump from yields from 1.7 to about 3.2% in a matter of about 7 weeks, and that pushed dollar up. And that was in anticipation of a very aggressive Federal Reserve. The overbought conditions normalized. What I am very interested in myself is just what happens with the stochastic here. So it's popping down. It looks like it's coming out of that 80. I want to watch it very carefully. The reason that I want to watch it is I'm not quite convinced that there's going to be much more downside here. Now, there's obviously a bias or a prejudice that's coming in here. We call it cognitive dissonance. You know, because I've been a dollar bull for quite some time. As soon as that starts giving in, you know, everyone has a psychological inertia to this. It's called cognitive dissonance, and the best way I think to explain it is, if you go out and you buy a car, whatever car it is, and then after you've made the purchase, you come across articles or conversations that have information that are generally negative about the car that you've just bought. People will tend to discount that because they've made the purchase. There's now sort of a psychological attachment, and you don't want to be caught on the wrong side. That's what cognitive dissonance is. It's a very powerful psychological aspect of trading. When we fall in love with stocks and they start turning, it's very difficult to become objective about it. And I'm kind of finding myself, I think, perhaps experiencing that with the US dollar, and I just want to vocalize that and try to be on top of that. I'll give you my reasoning for it in a moment, but what we can say quite objectively is that we're in zone 3 and that there's an expansion of the Bollinger Bands. And of course, if we go down to our daily chart, well, one would argue because we're in zone 3, it's really probably appropriate to see if the resistance levels get targeted by dollar shorts. So it's found some support at S1. Any sort of bounce to the central pivot or to the R1, particularly R1, because you can see there's a lot of price support, resistance, overlapping R1. So R1 could potentially be a target. So the dollar weakness is something that we must, or at least myself, needs to consider and see how it ultimately manifests. If we go back to that, we go back to the weekly chart. As I say, for me, I think the falling out of the 80 and perhaps a journey towards 20 would be undeniable. What I think may be happening, and I tag subject to correction onto this, is that I think we are potentially correcting here. I don't know where the end of this correction is. I don't know whether, but I think we're correcting. And I think ultimately some support comes in. Now, the obvious question is, well, why? I mean, why do I say that? The inflation does seem to be sort of peaking. The Fed does suggest 50 basis points come June, 50 basis points come July, and then the minutes do say that they want to reassess. Okay, good, and I agree with that. Where I get confounded, is with the quantitative tightening. Okay, So let me. I didn't put the Federal Reserve chart in the Federal Reserve side in our resources, but I think we must take a look at it. Okay. I'm going to bring that up now. Okay. Right, here it is. All right, so just take note of the website because it wasn't in the resources. So fred.stlouisfed.org. So the St. Louis Fed is really a very good site. You can download spreadsheets, charts. You can do a lot of tools on it. But this is effectively the quantitative easing. Let's just close this in. This is the quantitative easing. So here is March 2020, unlimited quantitative easing. So it starts very aggressive, and then there's a very ordered program where there is, I think it was 120 billion, subject to correction. I think 80 treasuries, 40 mortgage back were being purchased every month. It could have been 30 mortgage back, but the point is there was a consistent injection of liquidity every month, and this is being booked as assets, as they should be on the Fed balance sheet, and you're getting this big movement up here. Now, what effectively is happening here is money supply is increasing. We can actually probably bring in into money supply as well. Let's see what this gives us, which I believe is sort of starting to top. No, that's not right. It's only going to 2017. A lot of these series have been discontinued and then restarted. Let's just try this one. Yeah, this one's the wrong one. All right, so this is to April 2022. I'm just getting it up. And you can see that the money supply here is starting to hook. See that? So it's already starting to hook. Okay, so it peaked, it's started to hook. And we've seen, if we go back to the Fed balance sheet, yeah, it's reached its apex and it's rolling over. It makes sense. We're going into that quantitative tightening, right? Let's just bring this up. Okay, so it's hit its apex. It's sort of, think about it in terms of a parabola. It's hit the turning point in the parabola. It's looking now, starting to roll over. M2 coming down. That all makes sense, okay? And asking, so I think the coming rate hikes are already priced in. It seems that way. It seems that the market is now repriced. That's what it seems like, Anna. So perhaps there was a more aggressive discounting, and then now that the Fed has said 50 June, 50 July, perhaps there's now a repricing in because the market was looking for a more aggressive Fed. And I think that is what's happening, by the way. I think that's but where I think the analysis is going to get complicated is when we start getting the total assets starting to come down, when we start seeing that M2 money supply starting to come down. Typically, the way to think about that. So we've looked at the hook in the M2 money supply. We can see that the balance sheet has hit its apex. We know that we're going into quantitative tightening. Let's just understand what quantitative tightening is. It's effectively the Fed offloading. Okay, it's normalizing its balance sheet. It's selling assets back into the market. It's going to. I think it's building it up to about 95 billion come September. So we start off slowly and then hit like a constant 95 billion. But we've got 9 trillion to kind of offer there. We obviously won't do the whole 9 trillion. Where the equilibrium level here is, I think, very much an unknown. But prior to COVID, we're kind of looking. Let's call it 5 million. Okay, let's say 5 million. I beg your pardon, 5 billion is kind of. I'm losing my mind. Let's say that 5 trillion is kind of where we'll end. Okay, so kind of going from 9 trillion down to about 5 trillion. In other words, again, think about it in terms of parabola hitting that turning point. So is everybody sort of happy with I think it's very hard to argue that's not what's going to happen, barring any unforeseen circumstances. We're kind of at turning points now in terms of money supply. Now, that brings me back to last week's analysis. I just want to start it here at the beginning of the week, because we'll build a theme and just monitor around that. And I'll bring up my Microsoft Paint. And the the economic problem, you know what economics attempts to solve? Okay, it tends to solve a problem of scarcity. Okay, or it attempts to model the problem of scarcity. Scarcity. How far can we go in the economy with limited resources, with scarce resources? We don't have unlimited resources of anything. So this is the fundamental problem that economics deals with: scarcity. Okay, and the way that first-year economics students sort of get to deal with it, and it carries through to sort of second, third year, is with demand and supply. And I really think demand and supply is very much, where everything's at. In my opinion, it's an extremely powerful force, because it's looking at demand and supply. So let's just take a look back at. Let's just take a look back here. Right now, we've got. If I had to change this back to M2, let's just go back to M2. Okay, if we take a look at M2, then I beg your pardon, just wait for this to, there we go. We've got a fixed amount. Right now, according to Fred, there's this amount of cash in the economy. This amount, by the M2 definition, 7 trillion. I think, if I'm reading it correctly. In other words, it's a fixed amount. It's not 8. It's not 5. It's telling us it's a fixed amount. So if it's a fixed amount, well, it has to be a fixed amount. It's like this. Okay. And that, as the amount of money supply changes, so does our vertical curve. Okay. Let's step back in. And this is money supply. I'll just call it MS. There's a point to this. Just bear with me. Just bear with me. And we said it was at. We saw here on. We saw here it's at 7.58, right? So fine. Let's put in 7.58. That's where it's at. But the demand side is not completely vertical. It's not what we call inelastic. It's a linear negative slope. It's probably not linear, but it's negatively sloped. Okay, and we'll put it as MD. Okay, it's definitely non-linear. It would be a curve, but doesn't matter. We'll keep it at MD MS. And then what happens is we get a current interest rate. Why is it interest rates? Why is it interest rates? Because interest rates is what is the price of money. Is what we call. It's because it's the price of money. It's the price of money. Okay. Because on the y-axis, any demand supply, so it's going to have price on the y-axis. What's the price of money? It's interest rates. Any demand supply is going to have quantity on its x-axis. In this quantity of money. Okay, so that's a. Now take a look at interest rate here, guys. Let's call this. And we'll just put in 3% because I'm sort of just incorrectly taking the US 10-year yield. Okay, but just for a. So we kind of at 3%, a little lower now, but we'll just call it 3%. Okay. Now, what happens when the quantitative tightening continues to suck money supply, M2 money supply? M2 is a definition. It's a definition of money. It's kind of your coins, notes, money market accounts, and I'm not sure what else would be, but you've got M1, M2, M3, all different definitions. But if you just Google M2 money supply definition, it will tell you what it is. And then, so when the quantitative tightening pushes more money out of the system, what's going to happen to money supply is it has to shift, because we're going to be moving, say, from 7.58. We're going to move, let's say, to 6. Let's say we move to 6. Okay, so let's take this. We'll move this to 6. Okay. And let's just understand the mechanism here. Okay, let's just try and understand the. How did we get from 7.5 to 6? It's through quantitative tightening. Okay, I've just done the 6, but the point is we're moving left. We're moving inwards, moving to the left. Every time the Fed makes a sale of its bonds, it's taking money out of the system. So there's a mechanism that's going to be shifting the supply curve to the left, and we'll carry on looking at that M2 money supply, and all things being equal, we've seen it's hinged. It's hit that turning point. It should be coming down now. We should see the asset side of the Fed's balance sheet starting to reduce now, right? So it's moving. What happens, assuming that there is everything's being equal, so assuming the same money demand curve, assuming the same, what's happening to interest rates here? What's happening to interest rates here is, you can see it's the intersection is taking interest rates, let's just say from 4%, from 3% to 4%. Again, I'm just making these up as I go. The idea here is, let's just say another couple of months, and we've got another money supply curve. Let's say this is where the assets sale stopped. Let's say it's at that sort of 5 trillion. Okay, and what's happened to interest rates? Now we're sitting at sort of 5%. Okay, so in other words, okay, so let's just build on this. Okay, the Fed seems to be moderating in its aggressiveness. Fine. Whether that is truly going to be feasible or not, we're going to wait and see. But let's just say that is the case. We can't neglect the fact that the dollar is going to become scarcer. Dollar is going to become scarcer because there's going to be less dollars in circulation. That's the economic conundrum, scarcity. So over time, it just seems that the trajectory for interest rates is still higher. To me, just on a normal demand supply analysis. That being the case, will the US dollar continue to capitulate? I find that difficult to comprehend in an environment where there is an underlying support longer term for the greenback, for interest rates, okay, which ultimately supports greenback. So yes, at the moment dollar is weak, but I am going to the longer term chart and I wonder, does the stochastic truly roll over? That for me is the big question. And again, that may be cognitive dissonance, right? That may be cognitive dissonance. But the idea is, does it roll over? And if it does roll over, does it just roll over to here and pick up? Or does it go all the way back down to 20? My opinion currently is that there's support for the dollar. Why is there support for the dollar? Because there's quantitative tightening. It's a complete unknown that seems to be completely ignored by everyone, which is odd. It's just odd, okay? Because if that's the case, we're getting an almost perfect dip in an uptrend here that at some stage is going to become exploitable. That also means, okay, so this is where it now accounts for us as traders. It also means that any sort of rallies, say in the euro, now that the euro here is balancing, okay, does this have some sort of ceiling above it because of quantitative tightening? Okay. We know that the ECB is looking to tighten as well. I don't think they can be nearly as aggressive as the Fed is going to be, just because of its QT program. If you take a look at the pound, well, there's cracks that are starting to appear in terms of economic expansion. Just with a lot of the numbers, I think, are concerning coming out of the UK. I'm not sure the Bank of England has many more left to go in terms of hikes. Again, is there some sort of cap here, some sort of ceiling? My current suspicion is that there is. And again, I'm going to add on this completely irritating phrase, subject to correction, because we can only make economic analysis and then see if we're right or wrong. But it makes sense to me in terms of the underlying supply-demand dynamics that are taking place. So Anna's saying, how can they say inflation has peaked when it takes so long to actually show in the economy? So inflation is also, just like the unemployment rate, Anna, is a lagging indicator. Inflation actually lags as well in terms of the cycles. So that's maybe something to consider. But I would actually say your question has a lot of merit, because I'm not convinced we've peaked just yet. We may have. Okay, we may have. Again, I don't want to say that we haven't when we may have. Again, we looked at this last week, and we'll look at it again when we looked at US. I think I can't remember the code. I think it was yeah. I'm at the office today. All my notes are on my desk at home, so But in terms of the PPR, it does look as if it's rolled over here. So we just want to keep an eye on that. And then what we want to do in our deposit is we would want to keep an eye on the core CPR as well. And ultimately, I think that the crossover of what have we got here? We've got it's because I've got the EMAs. All right, let's get rid of the EMAs. Too many orange there. Ultimately, what we would want to see here is the PPR dip below CPR. I think that would be a really good. I think that would be a good development in a potentially stagflationary environment. So we wanted to see that, and of course, we don't want to underestimate. Even if the Fed is going less aggressively, you know, I think that again, it's potentially being underestimated just on past similar cycles. What happens when the Fed's fund rate starts creeping up, which we've looked at previously when we take a look at the Fed funds. I'll just put this on a new scale. I mean, we're really way behind where the Fed was on previous stagflationary cycles, which I think are many years behind us. So we're going really back to the 70s, which is you know, an age ago. So clearly there could be some variables, you know, that that I'm not seeing or not taking into account, but just sort of on a just a cursory glance of this particular chart, it seems to me that we're way behind. And I think let's put just one more in, because we did this last week. We won't spend too much time on it. And of course, the other important, I'm not going to put in unemployment right now. I'm just going to put in US GDP growth year on year, which was actually GDP for the first quarter was mended down last week from 1.4 to 1.4 to negative 1.5, from negative 1.4 to negative 1.5. Let me just try that once more. So I think, Anna, your points are valid. You know, I think though we've got to watch it, not get and just watch a bit. You can certainly see the GDP rates coming down, as was in this spike here, as was in this spike here. So it does seem a little early to call a cap, but we'll watch. When I say cap on inflation, I think it's also, to me, it seems that the market's underestimating scarcity, which is kind of, it's your first lecture of economics, scarcity, you know. So it's just, it seems a bit, you know, it just seems about something that we shouldn't neglect. Okay, so having said that, does the M2 drop as the stock and Bitcoin markets fall? Let's come back to that, Rob, in a moment. Let's come back to that. But let's just go to this chart here. US dollar. And I think that what I would want to see is, of course, how far down do we go here? And if we really get some sort of targeting by the shorts. So that's something that we need to, but if we do, my opinion is, again, I'm going to tag in that irritating phrase, subject to correction, is that that's kind of a short-term phenomenon. And if it's a short-term, I think that the dollar still has support out there. which of course now brings us to, well, let's start off with Bitcoin. I won't spend too much time on this, just going on. So Rob, if M2 money supply goes down, it's making the US dollar scarcer. So, I mean, traditional economics would tell you that it's going to support the US dollar. Okay, ceteris paribus. Okay, all other things being equal. If that's the case, then it seems that there's still headwinds for Bitcoin. Okay? That's what it would suggest to me. The stock market would also be troubling to me. It would also be troubling to me. I'm just going to use the US 30 here. Why would it be troubling to me? It will be troubling to me because I'm of the opinion that the markets have a addiction to liquidity. Have you guys ever heard of this? Have you guys ever heard of this? You guys ever heard of that? The Fed put? You guys ever heard of the Fed put option? Okay, what is a put option used for? When we did our options, you guys remember put options effectively insurance. It limits the damage of a downwards market. Limits the damage of a put option. The Fed always coming to the rescue with its liquidity to save the markets. Okay? So the question is the Fed put still operating? Because that's effectively why is there a Fed put there? There's a Fed put there because of a liquidity addiction, right? I don't think the Fed puts there anymore. We're tightening. We're going on to that quantitative tightening. That may have an effect on the risk market. Okay, so we just want to. I think that as this QT plays out, where we are right now to where we're going to be at the end of the year is going to be very different in terms of Fed balance sheet. It's going to be very different in terms of just money supply in the economy, liquidity. Okay, if you have an addict and you start taking away the addict's supply of whatever he or she is addicted to, okay, they crash. They crash. Okay, so I don't think we've got a Fed put anymore. You know, tongue in cheek, one could wonder if we have a Fed call because of the QT, right? So we want to keep an eye on it. Now, there's no doubt that there was a spectacular rally in the market last week on the US 30, to the point it's pushed us into zone 1. And if we go through to our hourly, we're extremely overbought. But any pullbacks here, well, the sentiment again might act as some sort of support, and we might bounce. I would suggest we really, for 2022, need to be, you know, obviously savvy enough to take advantage of any signals and positions that the charts dictate. But at the back of the mind, I really don't want us to be sort of lulled into a false sense of security. I don't think that Fed puts there. Okay, and let's just see how the interest rate environment reacts to that draining of liquidity. Katie asked if we can do the Nasdaq, and I'm going to go there next. And we can just do a top-down analysis here as a proxy for the risk markets. Do the same for oil, and just as to end off, we'll do the DAX as well. But you can see that the longer-term trend here, peak, trough, lower peak, lower trough, that is a downtrend. Now, we did have a spectacular week last week. There's no doubt about it. In order for the trend to really show a reversal, to show that the downtrend is no longer in effect, well, there's two ways for that to happen. I think the less realistic is that it just takes out this lower peak here, because that would be a phenomenal V reversal. It's not to say it's not impossible, but if it does that, then of course we don't have a series of lower peaks anymore. Then this lower peak would be cancelled out because we would have a higher peak. But something that I think, Katie, might be more realistic would be something like this, assuming there's a trend change. Okay? That would be the higher trough followed by the higher peak. The other option, of course, is that we just in the midst of another dead cat bounce. Okay, I mean, look what happened at our previous dead cat bounce. Okay? We had a tremendous amount of emotional buying here. I can't quite remember the media stories, but I would tell you that the media stories here would be exceptionally positive. Okay, only to be hit by the next lower peak and the next leg down. Just be aware that this could be the next. It's not the bear markets that hurt. It's the bear market rallies that hurt. We go through to our daily chart. Sure, it's now looking like it's wanting to get into. It's looking like it wants to get into zone 1. Not quite conclusive, but we'll keep an eye on that. Katie asking, what about the fundamentals behind the Nasdaq? So I think that we have to go back to trading view. Let me just clean this all up. And the fundamentals will be again linked to that time value of money. Let's go through to the US 10-year here. And let's just come through to the, let's go through to the daily now, see what's happening here. You see what's happening here. So here we hit 320, okay, where we now we're at 270. So we've 25 basis points off the top. See that? 25 basis points off the top. Let's add the Nasdaq to the bottom of this chart. All right, and let's just get in a vertical. So here's the top. Okay, so very much the top of the US 10-year doesn't quite align with the bottom, but we can say that from this point, the Nasdaq found its support, and then as the US 10-year started coming down, Katie, that's when there was some sort of buying in terms of the Nasdaq. Again, that's the time of value of money. Remember that because growth stocks pay the dividends out in the future, they're extremely sensitive to any interest rate changes. That means that they benefit from interest rates coming down, but they get really smashed when interest rates go up. So we've seen this coming down. This is that head and shoulders that Rob mentioned last week. Okay, so that the Nasdaq's been a direct beneficiary of that. Okay, so but again, what I would draw your attention to is what's going to happen to interest rates over the course of the year as we start getting into that quantitative tightening. And if my suspicions prove correct, they might be incorrect, but if they prove correct, then it seems to me that we're going to have higher interest rates. And if we have higher interest rates, Katie, that's going to hurt the growth markets. So we go back to sort of our weekly chart here, and do we have some sort of higher trough coming here? It was overbought, remember, it was overbought. So this movement down here, I don't think is surprising in the least. It was, I think, mentioned in our webinars that well, we overbought. How much further can we go in terms of being overbought? And the idea here is we're no longer overbought. We've actually got a platform now. If rates are going to go up, we've got the platform to take them up. He's just now looking to see if we're going to get this higher trough in. And I would suggest one way we could look at that is we go back down to the hourly. And we can take a look at this on a number of levels. When you just put in so we're on an hourly, right? So let's just put in a 30-hour exponential moving average, which is Stan Weinstein's moving average, right? So let's just pop that in. All right, so what does Stan Weinstein say? And we've gone really right down. We're on a 1 hour here, so just the analysis here is slightly different to the time scale that Stan used. But we can see here would be the actually even goes further. Okay, let's use this one. Here is the distribution. Here is the markdown. Well, question is now, what is this? Is this accumulation or is this further distribution? And that's the big deal, Katie, because if it's further distribution, okay, then we would expect a breakdown to the downside. Breakdown, of course, let's go to the downside. Well, that would be beneficial to the Nasdaq, wouldn't it? But if this is actually accumulation, okay, then we might be in the midst of that dead cat bounce. So there's your fundamentals, very much a factor. Does that answer the question there, Katie? If there's anything I've left out, let me know. But I'm going to go to oil now. Just cognizant of the time. Let's just go through to oil. I'll use UK oil. And the last time I looked at oil, it was actually moving up. Let's just see what it's doing now. And it is moving up. And I think, by the way, Anna, this is another sort of reason why I think your question was so good, because, well, if we get to 150 here, what does that do to inflation, right? Yeah. Do we really have that? Do we really have that peak? Do we really have a moderation in monetary policy? I mean, we've got a lot of unknowns here, a lot of variables that we're still working with. But you can see, so we've broken out of a flag pattern. I think I wrote an article on this. In fact, I think the WTI CFD is showing exactly the same. Okay, high trough, high peak. We are moving into the zone 1. I'm more comfortable with the oil market being in zone 1 than I am with the dollar being in zone 3, which I think is an overshoot. Again, I'm going to tag on subject to correction, because I've got this cognitive dissonance playing in the back of my mind. UK oil zone 3 as well here. So, well, what happens if this carries on moving up? Okay, come back to Anna's question. How can we say that inflation has peaked? Okay, I think that we've still got to look for that PPI graph across that CPI. That I think would go a long way. Anna. Another thing just to add in here is wheat. Okay, which is another chart we've been using to assess stagflation. And at the moment, well, that's not right. It's actually now moved into neutral. And we'll just have to keep an eye on the price of wheat, because if we get it coming down. I think maybe that will, check the box for perhaps we have peaked. But if we get another higher trough moving up here, well, that's going to make that stagflation more intense. Just for the last chart, the very last chart is, let's just take a look at the DAX. And the DAX has been a much better performer than the Dow, so there is relative strength on the DAX side. And we are now moving into this critical area of overhead resistance, and we want to just watch that. Okay, if we can get the stochastic into this 80 area and hold, we will break it. We will break it, and then again, that's going to, I think, bring in a lot of questions for me that I've got to try and analyze and make sense of. If we go through to the daily chart, we certainly are looking bullish. The Bollinger's are expanding. There does seem to be some bullish volatility there. We're overbought. So now the question is, the risk reward profile here is skewed. Okay, so if you go long here, you are exposing yourself to the prospect of a pullback. So the question is there going to be some sort of dip that's supported? Okay, so that's the DAX. All right, any final questions before we conclude? Go ahead and type those through. Any questions, guys? All right, you've got my email address. We've got non-farm payroll Friday, and then I want to wish you guys a good day ahead, a good evening ahead, and we will chat tomorrow morning. Thanks very much, guys.